Welcome to Inside Open Technologies, presented by CSuite Edge.
Hi, and welcome to the CSuite Edge Inside Open Technologies. I'm your host, John Light. I'm also the founder and CEO of Sabretooth Recruiting. And today, as per usual, I have someone I'm very pleased to have as my partner in crime, so to speak. I don't think we're doing anything illegal today, Mark, but thanks so much for joining me again for another episode.
You bet. Anytime.
Well, and today we have this interesting nexus of personalities and backgrounds with Erik Bergrin, who is the founder of Valhalla Capital Partners. And I know, Eric, that you and Mark and I kind of connected through this nexus that we have in an earlier episode with Ryan Baird at Baird Augustine and the Silicon Valley Economic Forum. And thank you, too, for making the time to join us today.
Yeah, of course. Thank you so much for having me. It's a pleasure and great to see you again, Mark.
Yes, always. Yes.
Yeah. So it's interesting to me because this is the first time I've been recording a podcast where both of my guests are in mountain time zones. Usually somebody who's West Coast and maybe East Coast, and when we're trying to bounce all this together. So to me, it's a little fascinating because we all are in very different areas of the country and bring very different backgrounds to the table. And I'm curious, Eric, because people who've listened to the show, they're familiar with me, they're familiar with Mark. Maybe you could give us a rundown on your background, and I'd love to get a little brief as well on where you took things as a keynote speaker or as a speaker at the Silicon Valley Economic Forum as well.
Yes, for sure. Well, again, thanks for having me on the podcast. That's very much appreciated. And yeah, normally I reside in Florida, but it's end of July and it's definitely a little hot. So I have changed my scenery to 10,000 feet up in the mountains in Colorado, where I'm at right now, talking to you straight out of my little training camp here. So I'd take a step back here, guys, and say it was almost 15 years ago, and I'm just about to go and start a bike race with my buddies out in Stockholm. I was out there for a little get together again, and my brother calls me and he says, "Are you sitting down?" It's like, "What's up?" I could hear something's wrong, right? And he says, like, stage 4 lymphoma, 30% chance. And he was just about to have his first child. 6 hours later, his first son was born. And good news is that I have 2 nephews and I go ski with them every winter. And my brother is fine and they're living a great life up in northern Sweden now. But that changed me. It changed me to start thinking about longevity. And how can I actually change my lens? How can I live differently to actually take more advantage of life and have a bigger impact and just literally refocus from trying to win a race and being so focused on just like right there and right now to actually create a system for a little bit of a longer range. And what I started doing is I'm starting looking at my whole life as a system. Both my internal like longevity, and it changed how I ate, how I train, how I sleep, and how I approach life. And I actually very literally last week launched my first book on longevity that is available to listeners if you want to. It's called saunalikeaviking.com. And it's really about how to use hot-cold contrast therapy to help rejuvenate you and make you sharper and better as part of that system. And the other side of this coin, and why I was out speaking at the Silicon Valley Economic Forum a couple of months ago regarding private credit and what that is that I also wanted to decouple my life from one single entrepreneurship or one single career in a W-2 fashion where everything is just one singularly focused. So this changed me 15 years ago. So that's a little bit about the background of what that is, John.
No, wow. I mean, that's pretty intense. I mean, I knew you had the book coming out, but relating this back as you have to your brother and that, having dealt with cancer myself, I know it's a harsh challenge for anyone to take on. So I'm glad that he's doing well, and I'm glad it's taking you down this path. And I know I'd love to hear a little bit more about what you shared there at SVEF. And what's driving you now? What's driving Valhalla Capital Partners in the marketplace? I know Mark has some questions as well to carry on from that, but maybe you could paint us a picture on how Valhalla Capital Partners is addressing this for entrepreneurs.
Yes. Let's move in there a little bit, and let me ask you guys one thing. If you're think through this a little bit, right? What's more important, a one number, which is your net worth, or do you actually have more money coming in every month than going out? Are you getting richer every morning when you wake up from the night before? I realize that the latter is truly what matters if you want to live free. And freedom from, and that's why this whole health and wealth creation is so symbiotic for me. If you can create a system where you actually have cash flow, decoupled from your passion, your risky bets, whatever you are doing, and that you also are setting yourself up for, and it doesn't matter if you're actually what level you're at, as long as you create cash flow that is higher than the lifestyle you want to live, and you get richer everywhere you want to do. And that is the system I started building 15 years ago, because I was lucky enough to be part of building a company out in Silicon Valley. And as we were selling that, it was the first time I was getting my hands on capital more than, just commission checks and bonuses, etc. So it gave me the opportunity to start playing and doing different things. And what I did, and also why we founded Valhalla a couple of years ago, was really to build that system of passive income. And when I have found that there is a way to systematically live very free, live better, you got to start with something. But most people that have a career and have had a high income or are really good at certain things, they have the opportunity to do the same thing. And I really wanted to help people do it. And I set a vision for Valhalla, and that is to help people do whatever you want, wherever you want, with whomever you want, and of course, whenever. And if you can create that freedom, that is the definition of Valhalla here. And of course, everybody has their version of this. What's important to you? What's your purpose, etc. But I founded Valhalla with that. And the main problem that I've seen that a lot of high income earners, entrepreneurs, risk takers are doing is that they are getting too concentrated. They're having too high concentration risk. And what I mean with that is that if you allocate your time and your capital into the same bucket, you are at the single point of failure.
Yep.
I sometimes get inspired by military quotes, and I know our friends in the Navy SEALs, they said, 2 is 1 and 1 is none. Why would you ever want to expose your life to a single point of failure? The reason I'm sitting here and talking to you guys in the kitchen here right now is that I am running on my backup internet from Starlink. 2 is 1 and 1 is none. You have to apply that thinking to your own life and have the backup. So if you can decouple where you spend your time and energy from where your money works, then you actually have 2 streams. And what I have found is that you can actually do more and better and take more risks. And obviously, with more risk, you can have a higher return and you can actually work on things that is really impactful for you if you don't have to constantly look over the shoulder and know how you're going to pay next month's bill, because you're so dependent on that one single source of income. So that's a lot of what we're helping with in Valhalla.
I see that all the time, right? You see, very powerful, capable professionals that, they're locked in, doctors or lawyers or any type of professional person. And, their career is everything and their income is everything. And their lifestyle is driven by all of that. And they call it the golden handcuffs, and, they can't walk away. They're stuck. And they're not, but they're not happy where they are. They'd rather be doing something else, but they can't do something else and maintain, the lifestyle to which they have become accustomed. and it gets ugly. It's a real mental challenge, I think, for people to get over that. And it's interesting how you've figured that out, and how and your approach to it is pretty smart.
Yeah, I mean, hearing something from you, Mark, saying that something is smart, I take that to heart. So thank you very much for that.
You're welcome. You're welcome.
And yeah, I mean, our latest investor is a shoulder surgeon. She runs the whole clinic for that, and she was a referral from another investor that decided to go with us. And she literally just called me 2 weeks ago and said, I'm friends with Tim, and Tim is a great investor of ours, and he's been a lot of fun working with him. And he said I should talk to you about potentially reallocating some of my retirement savings and funds. And literally 10 days later, she has become the latest investor in Valhalla. She signed up for us last week. Awesome. And that's a perfect example with the concentration risk. Obviously, she's awesome. She's really good at that. And we got a little deep into talk about longevity and alternative treatments and fixing this and that. But coming back to this, for her, it is still too much concentration risk to do that. And for a lot of people that are in this kind of more retail mindset of how to save and think about retirement, they've heard repetitively. And I want to be very clear on this. I think this model is always wrong, always has been, and just because we keep repeating it doesn't make it right. And the model I'm talking about is this 60-40 model. Set aside as much money as you can from your active W-2 income. Pre or post-tax is a different kind of conversation, but put it in stock market and bonds. And then that's gonna, whatever stock market does over time, 7, 8, 10%, depending on when you're coming in and out, of course. But over time is about what you get. And bonds like barely beating inflation, right? Yeah. So it's not really going to create a big nest egg. But here is what's so weird with this play, guys. And I just cannot understand it. And I want to help. I want to get people to start thinking from, first principle and do better with their lives and investments because they're so commingled. What advice is it to say, yeah, and then you have a stock plan of money and start burning it off 4 or 5% a year. And you know what? Hopefully you die before you run out of money. But guess what? I got news for you. If you are now in your 40s or 50s or 60s and you have some good health, there is a very good chance that you're going to live a lot longer. Whether it is because you're taking care of yourself so much better, or if you actually start doing hot-cold therapy that I'm talking about in the book, or if you're doing other more modern biohacking things, or you get access to more modern medicines and you do other things. The whole idea of creating a system where you build a pile of cash and then you just burn off a few of those bills every year is, for me, absolutely horrific. And I can't believe why people keep going down with that model. And I want to change that model. I want to help people to put their money aside, let the money work for you while you sleep. Don't burn down the principal ever. Just live off of that yield. And then you have created something that actually lives on in perpetuity. That unlocks freedom.
Yeah. Now, for entrepreneurs, folks like myself, I've done now, multiple companies and multiple exits. And what we're looking for is a lot higher than the normal stock market does. There's the private equity markets have really changed things a lot over the course of the last, say, 20 years or so, right? And the real deals are there. And so that requires some knowledge, though. And I think in terms of people like me, where I go from company to company and create a tremendous amount of value, and that for me to expect a 20-30% kind of return is kind of moderate. And so that's why some of us focus, but I pay a price for that. And the price for that is, I've got a lot of eggs in one basket. And so, some of my other baskets are in the stock market where I've been consistently doing 10% a year for a long time. And, that's built up nicely. And that's but it's not. You're right. When you decide, it takes many millions to be able to just live on normal dividends, and that's really the challenge that people run into. Now, so if you could kind of blend those two concepts a little bit and come up with a business model where you can actually be fairly passive about it. You don't have to be active, so you don't have to destroy your life trying to get, those 30-40% kind of yields. And but you can do consistently better than the typical dividend yield on an S&P 500 kind of fund. Now you're, that's the game here, right? That's what we're really trying to look at, and that's kind of how you're going with Valhalla, right? That's your real claim to fame there is how to generate those kinds of returns on a pretty conservative investment strategy. So can you talk about that some?
Yeah, for sure. And I mean, thanks for the tee up there. And I want to take a step back and say this. Everybody's situation is very different, right? So it's not like always like one size fits all. But I was just pointing at something that I think is absolutely wrong, which is this 60-40 saving and all that.
Yeah, the 60-40 mix is terrible.
Yeah, and it's just this advice that it's just coming, and I just feel that it's just so awful. And I mean, it's so weird. It's like philosophically, I try to save people and try to help people, right? It's like, but it's in a capitalist system. I think number one is that wherever you are, you got to be very intentional about your total asset allocation. And it doesn't matter if you're a big, wealthy, second, third generation family office and you've been trained and you have helpers around that, or you're one lucky guy that had a good exit, or you're that, super high income earner, or you're younger and you have this career or whatever. You got to be intentional with that. And I can share my philosophy, and I want to make clear, I'm not suggesting everybody else's needs to be like this, but you got to be intentional. So I do 4 things. Real estate. That is, you got to have places to live and be, and think that's really good for long-term capital preservation. And it also plays pretty nicely with taxes, with the other bucket of this. And the second bucket, which is the biggest by far, is private credit. And I've been doing this for 15 years in various types and capacities, learned a lot. But the point here is that when you are a creditor instead of having equity, you are more protected. You get paid first in any downside scenario. So if you can help building business, create jobs, creating housing, or whatever is important to you that you do with your capital, then if you are structurally protected with credit, that's really good. And this is actually in a fund that we've been involved with for a few years. That's why we founded Valhalla, to let others actually invest alongside us, alongside my family office. So I have my own money in there and had that for years. And then as an extension of that, offer that to both what we call retail accredited investors and also other offices. But here is something, and this is something you and I talked about, John, what you were very excited about earlier as well, is that since I have done capital preservation, I have income, structurally protected, steady income every month, more than I need from that. And yes, it is pretty high yield. I got to be careful with how I phrase that. And if accredited investors want to learn more about it, just go to valhallacap.com or connect with us individually, so I don't get in trouble for talking about the yield we're having. But you have seen the data there, Mark.
Right.
But the third bucket for us is angel investments. And this is where I can come in with some high conviction, and my buy box for things where I put money behind entrepreneurs is something where I can be accretive. I really like the people behind it, and I do believe that that idea is going to do something that is really good for us. So one example is that we were the first seed investors to build help build a company in the defense tech industry over in Scandinavia, to basically help protect the Baltic Sea from the Russian threat there, which is very real. This is something that's very important to help with that freedom fighting. And I felt we could come in, we led that, and we can do that, and it's very much out of conviction. Another thing that I'm involved with that I think is fun is with some younger, very successful entrepreneurs in the AI space. Of course, everybody's in the AI space, but then I can allocate time to them and, just help them guide a little bit, because AI changes everything in terms of logic and business dynamic and everything faster than we've ever heard. And we hear this all the time. But there are some things that are still true. People buy from people. And you got to understand what's more important than the other things. So helping these entrepreneurs with a little bit more of, learning from my own mistakes and my success. And then that allocates another part for me in the fourth bucket, which is by far the smallest. That's what I would make a bet on something that I believe have a 50 to 100x return. And these are, for the most part, like deep tech things, like something I have no control over, how you're going to build a nuclear plant underground, or, start beaming solar power from space, or something, how we build infrastructure on the blockchain for some cryptos. I don't buy crypto directly, but I'm interested in being part of some of the infrastructure that actually builds that whole ability. So that's the smallest allocation, but I can afford to lose there. And I can afford to be like my own little venture firm with those things, because I basically allocate my time and my skills and experience and my convictions into the angel investments. I play and I help with things that I think is important for the planet, or things I believe in, with smaller tickets, speculatively. But it is because I have this foundation of structurally protected credit that is coming there. And for us, when we do this investment private credit is just lending, right? So we're part of that. We don't need to make it sound so complicated. But the lending that we are involved with and that we are supporting is for residential housing in Middle America. So what we do with this is that we create jobs and we create housing for, working class or middle class families to sit and have breakfast and talk about their next baseball game or whatever they talk about. That is what I think is really great, when you can allocate capital to actually be part of building something, yet provide great.
It's, everybody's capability to handle this. And, there are some of us that'll just go all out. I fly airplanes upside down for fun. It doesn't, it doesn't go, you don't go too much further than that. And so we can understand how, how that risk reward thing works. And some people understand it better than others. But most people have a real hard time with that. And so, like I say, being intentional is good, but even sometimes people's best intentions aren't good enough. And they end up, kind of chained to a desk for their whole life. And that's kind of sad to watch. But I really wonder if these kinds of, if this overall kind of plan starts to catch on a little bit, I think it's just an educational process. And you're right. I don't like the 60-40 thing at all. I never have. I am much more specific about what I invest in, but I also invest more in stuff that I am directly involved in, which is kind of it's a vicious cycle, right? Because I'll put money in things, and then I'll be very involved in that, and but all my eggs are in one basket, and I'm watching that basket really carefully. But that creates stress that just goes through the roof, and most people don't handle that well either. So I get your point. I definitely get your point. I'm the poster child for that.
Yeah, it's this. Go ahead, John.
I was going to say, my dad used to tell me when I was young, or very younger.
That was a long time ago, John.
Yeah, a long time ago. He would tell me, and of course, this is a man who didn't, he left this life without a whole lot to his name, relatively speaking, right? Outside of reputation and character and this sort of thing. But he used to tell me that, look, if you don't have much, you need to put all your eggs in one basket, that's okay, but you better watch that basket. And I think that's part of what Mark is pointing at there, is he's putting eggs in a basket, and he's like, I'm going to be involved with this basket. And what appealed to me in our pre-show conversation a week or so ago, Eric, was when you talked about what you just touched on a little bit about having the freedom to do these other things, that your involvement in the real estate and the private credit side, this private lending, if you want to put it that way, gives you the capability to do so much more than you would otherwise be able to do. And I personally find that very appealing. To me, that's a large part of what we're trying to do. I mean, what good is making money and maybe even having a very successful exit and pocketing a mint and going on about your way, but not being in a position to give back? Because every time you help someone out as an angel, or you speculate, you take a flyer on something, there's that risk reward calculation you go through, but it's not just risk reward for yourself. It's risk or reward for that other individual or group. It's risk reward you got to consider for that you said earlier, the market or even the world at large. Something could be very impactful, especially in this day and age when things are changing so fast and so materially. It can be really hard to keep up. So I'm curious, if you were going to talk to someone about this relative to the risk reward that's out there, a lot of people, I think, could have some fear of starting in this, right? Going down this road, doing something outside of the standard 60-40 or whatever they've heard their entire lives. How do you approach that? Because I get it, and I've finally made the connection. Thank you, Mark, for throwing this out, even though I know you didn't intend it this way. And you start talking about your Valhalla, and Eric starts talking about your Valhalla. It's like, this is how you want life to be. Your paradise, your choice, you're all this. Yeah. And I'm like, oh, you dolt. I didn't say that out loud, but I certainly thought it in that moment. But how do you approach that with people? Because, I look at this as like, well, you'd be crazy not to engage. You'd be crazy not to explore because it gives you freedom. I mean, how do you engage with people who maybe haven't been able to articulate that freedom is really what they're pursuing, and instead they're really focused on security and stability?
Well, they think they're focused on security and stability, and they're really not.
That's exactly right. And we basically work with two constituents that are, partners, investors with Valhalla. One is with people with quite a lot of money, wealthy family offices or high net worth individuals that had money for a while, and the right advisors. So in the private space, they are pretty savvy. They go straight in and just compare our deals, and they invest with us simply because the risk reward is appealing to them. They look at, okay, is your money in there? Do I get a pref share? How is the downside protected? What's your track record of an upside, etc.? And when they go in and really dissect that, we come out winning because we have a very compelling offer. When it comes to the other part of what we're doing, so I don't need to change their life. They're already there. This is just, we co-invest, we're partners. So that's already good. But for the people that are so kind of indoctrinated that it's going to be in a certain way, and I don't want to suggest that all financial advisors are bad. I've met many, and many of them are really great. But sometimes the incentive structures for what they're doing and what they're offering is not completely lining up. And sometimes just to break through a little, what do you call it? You got to break some eggs to make some omelet. Sometimes I have to ask little provocative questions, such as, if you're listening to your financial advisor and if his or her advice is so great, how come that person is not rich? Are you taking advice from a fat doctor in terms of longevity? And I don't want to be rude or in someone's face when I say that, but you asked a question like, how do I actually break through? And I was planning on, and I kind of laugh about this, to, maybe semi-retire a little bit a couple of years ago. And then, that was on a Thursday, and on Monday, Valhalla is born because I burned so much for doing it. But I think you alluded to this earlier, John. It's a lot of education. And it is so hard for people to change their mind. And people are very attached to their wallet and money, and they think familiarity is safety instead of actually thinking and looking at things from a first principle. And I feel I'm busier than ever, but I love all the conversations I have. But it's almost like being traditional sales guy that have strong conviction for your product. I have a lot of meetings and I do a lot of education. And for people that actually have that ability to think from first principles and start thinking about, okay, what is it that I actually can do and should do with my money here, rather than just following a norm and throwing it into some expensive funds and let someone actually get an AUM fee for doing absolutely nothing. Even when money goes down, they get paid. Why? That is wrong. Yeah, I do public speaking. I was invited to that Silicon Valley Economic Forum, and I get a chance to talk to many people. And that was really cool, because then it's not necessarily the people that traditionally invest with us. It's actually entrepreneurs. It's high risk takers. It's dreamers. It's the guys that are building the next moon rocket in their garage. And some can be very successful and many will not. And it's just a very eclectic group that is attracted to that. But the short answer is, be a little provocative to catch someone's attention, and then, real true education.
I like it. Well, there's
So-
something to be said for provocation, that's for sure.
Yeah. Can you talk a little bit about your debt, your debt products, and how does that work? What are you're financing mortgages, but are you a mortgage REIT, or how does that actually function from a business perspective?
Right. So to be clear on the business model, Valhalla Capital Partners, we are looking after the investors. An investor invests with us. We are a feeder fund into the best products that are out there. And we are backing an existing lending operation that's been in business for 3 years. We came in early. We put our own money in there and backed them when they were a little bit more unproven. Today, they do hundreds of millions of dollars repeated like this, and I am so proud of them. They still have not had a single loss. The velocity of lending is just so fast, and we are providing more capital to them so that they can grow and expand geographically. So it's a very niche kind of lending. And this lending, and what I've found from when we were doing our own lending, it's kind of one deal at a time, it's underwriting. And if I've done notes where I really felt like I've been helping people, but it's still been 25% notes and it feels like really great return. But if you do that and you just have that, it'll lean maybe to an accounts receivable or to some products and you help turning a company around, it's great. We've done that. But that's very risky because it's still just like that one company, and all that needs to happen is that there's like a fire in the warehouse, or the founder gets sick, or the customers start liking other products more than theirs, right? I mean, there's so many things that can go wrong. But what we're doing here is that we are backing a lending operation that is lending to developers and landlords only in Middle America, and the demand is high. So anytime you want to do business, you want to be somewhere where demand is high. And also, competition is weak. There is virtually no competition. So they operate almost in a vacuum of it because the banks pulled back. The banks don't participate in construction loans, and they don't do landlord loans. They're technically called debt service coverage ratio loans. And there are, of course, national lenders that are doing this, but they don't always show up in small towns in Colorado or in Kansas because they don't care about a $300,000, $400,000, $500,000 loan. The tickets are too small for them to care. So that's why there is an opportunity to meet and support this demand. And they do two kinds of loans. One, short-term lending, construction loans, draw-based with a Dutch structure, 6 months typically, a couple of points up front and a coupon rate. And those sit on the balance sheet. They are lower risk because they are issued on a draw basis. And they're also profitable this way because if you get the full draw over 6 months to, build a new house, you have to pay for the full line up front. That's just sort of what the nature of it is. But you actually don't get the full amount of capital in your hand from day one. You're getting capital as you're progressing through milestones. And this mechanism is driving strong profitability, but obviously it also reduces the risk for the lender of doing so. And then the other side of lending is those landlord loans. And the fund operates in a niche with smaller landlords. So think about someone with like maybe 4 to 10 doors, and they want to leverage that. They can get a 30-year fixed mortgage. They pay, some points up front, and then you get a 30-year fixed mortgage. And then the fund sells these mortgages. They don't sit and stay on the balance sheet. And they have a well-developed market for selling them. And this is kind of the peripheral and the supporting business to the bread and butter, which is the balance sheet lending. But very often is it the same house that is just going from a construction to then wants to have a refi. Sometimes it's even the developer who becomes the landlord, or it's a transaction where a landlord buys a build of that, but the lender obviously knows the property very well and makes money first on doing the construction loan and created the housing, and then help leverage this. And then when the loans are being resold, you get some points because they're so well underwritten and there is a high premium for that to be paid. And when you can get paid a few points and you're turning that around, and in this case, it's actually turned around 17 times per year. And just for the funds of it, if you multiply 5 times 17, that's 85%. And I'm not saying everything is going that way, but you can see the magnitude and the profitability of this once it's done right. So that's a little bit more of the nature of the lending. And what we are doing is that we came in early with our own money. So we created very good terms to help back this lending operation. And that's where LPs still have a chance to join us now as this company has matured. We still have this same structure for that. So that's what we're doing.
That's interesting. So you can help them grow, and because they're capital limited because there's no leverage there. They're using their own capital to make that work.
They do use leverage, but pretty limited, and that is to make sure that you can have a little flexibility. There's always a certain number of $1 million that needs to sit in a cash balance all the time. But if the business development is a little bit ahead of how much money we have put in, you don't have to say no to that deal. You can do it and do it. But it's very conservative with the leverage. But yeah, if you have the ability to basically lend at 14 and your cost of capital for that part that's levered is 7, I mean, I just made simple numbers, but it's in that vicinity, right. 100% return on that. But they don't need to and want to have too much leverage just to reduce the risk. So 25-30% of total leverage.
That's low. That's low. That's very low leverage for an operation like that. That speaks well for the risk profile. Cool.
Yes. And when we got into this first, Mark, I mean, I know you got excited when you learned about how the model works and the return profile that you have seen. But for me, I felt like, you know what? I'm going to sell some real estate. I was done with 2 a.m. calls and driving around with my own truck because I never could find anyone to help me and fix a toilet or chase a tenant for late for rent or whatever. So one little bit more kind of passive. But rule number 1 was do not lose capital. So when we approached this, our idea, and this is coming back to the system again here, right? And when you have the credit part and not equity, I don't want to gamble with the money. I just want to put my money sitting there and being paid structurally to an agreed term. That's what lending is. And if it doesn't work out, you own the underlying property, which is what this fund does. They have a 30% equity position with a first lien position on it. So it's a very strong position to be in. And that's where we want it to be.
Makes sense. It makes sense. Interesting. So this is one part of Valhalla, and then you have Valhalla Capital Partners, and then you have you still work a fair number of other deals for startups and other smaller companies to go with that. And you're not taking an equity position, you're taking a debt position, which puts you in a pretty good position if something happens. And it's a pretty smart move.
Yeah, so what we do, so Valhalla Capital Partners, the only thing we let other investors invest alongside us in is in this credit fund. When we do our angel investments, similar to what you do, you get engaged and all that.
Yeah.
We use both equity, and I use my own time, and we can use debt. We have all three of those different models depending on what we do. Whatever we think is relevant and accretive for that. But this is higher risk. And this is also more dependent on, my or my partner's particular involvement and skills in that. We do not take other people's money for that. The only thing we use other people's money is to try to help them get to a place where we think it's like, here's a structural, more protected income generating and stability generating fund. Because again, for us, that's like the platform. We don't have to look over the shoulder. That's what we're trying to do then. They can do other things. On a friendly basis, I mean, as you know, when you're involved in a lot of things, you see a lot of different deal flow and opportunities left and right. So sometimes I feel I'm a little bit of a traffic police, right? It's like something comes and is this for me? Is this for us? No, but I know this, and talk to Gary or Brian or Lisa or whatever, and you're connecting a lot of dots, and we don't have the capacity to be involved in too many of these, because anytime I make an angel investment, I'm personally vested in it. And that means, after a handful of things, I just can't really do more. Then we have the speculative bucket. And then, if it is something that's going to, save the planet or, make, things better in general for bigger things that we care about, and it has a 50 to 100x return, we might put something in there, but we're totally aware of that has a low chance of winning, but if it does, it's worth it,
Yeah. Med tech is like that, right? And that's where I spend all of my time is in med tech. But there's med tech, and then there's drug discovery, and I'm not a drug discovery guy. I don't know enough about certain aspects of it, but I know guys who do. And I just pass it. I just pass those off to those guys, and I stay in my lane where I understand what's actually happening and can do like you do. I do the same thing when we're talking about investments in companies. I want to be very involved because I want to know what's going on. But that's also part of what I bring to the table. Is when I'm making a personal investment, it's not just money. It's about those connections. It's about helping them get through the regulatory process. It's all of those things that are medtech. But there are so many people that have made investments in medtech and have gotten badly burned because it's a very fraught process, and it's pretty easy to look at something and say, oh man, if this works, it could save the world, and then they really didn't understand that the probability of it working is maybe pretty low. So I get into all that too, in the same way, and we just got to be aware of what we're doing, and I appreciate your two-sided approach to everything. And so for LPs in Valhalla Capital, that's really more on the structured side.
Yeah,
it's good.
Yeah, that's only on that, lower risk, higher yield, stability, structural part. That's where we feel very comfortable of, knowing money sits for the long haul.
It's an attractive product. It's an attractive product for sure.
But doesn't that kind of also support your thesis about giving people freedom? Right? Because if you have that as your foundation and your money's working constantly, and I mean, if you're talking 15, 17 turns year over year, holy smokes. I mean, that's just ringing the register, man. I think that's really what it's
mailbox money.
But I think that's really what it's about, right? Is allowing someone to have this platform, this foundation behind them or underneath their feet. So there are other things they're interested in that they want to take a risk on. They have the freedom to do that.
That's exactly right, John. And I have befriended one of our investors, and his name's Marty. And Marty is like in his mid-50s, and he is so passionate. He's a great guy, full of energy, and wants to do a lot of things. He's so passionate about his AI breakthrough. And I've looked at it, and it's like, yeah, you have a great chance. I mean, they're absolutely, this can happen, right? But he has a family. And he still needs to provide for that. And he says, Eric, I'm spending like 60 hours a week working on my startup, my dream, and I want to go there, and I'm raising funds for it, and I'm talking to this and that partner, and I've created this deal here, and it's like all this energy, all this passion, and it's great. But what Marty did, he put his retirement funds with us. He also put aside a few hundred in what he called like some kind of income insurance. It's not a technical term I can use, but that's what he told me it was for. And what he did is he put aside that money so that he didn't put it both that free capital that he had, the reserve capital, and his time into the startup. And now, every month, does he get a report, and he can see how much more, because he doesn't take the cash out. In our fund, our investors can choose whether you want to get cash in your hand every month or if that is being reinvested. And anybody that knows how compounding interest rate works knows that it becomes pretty handsome when you're reinvesting not on an annualized basis, but on a monthly basis. So he set aside money that is just sitting and ticking and growing and growing. And based on his estimates, again, not mine, his, based on past performance and whatever he felt comfortable with when he understood this, he said, you know what, Eric, this is quite intense because I think I can double my money every 3.5 years. All right. If you're right, Marty, you put in 500. So in 3.5 years, you have 1. In 7 years, you have 2. And in 10.5 years, you have 4. What if you flip the switch and start taking the return that you're expecting? Then, boom, you never have to work a day in your life. He could do that already at the 2 level.
Yeah.
Because you can do the math with that. And that's the kind of stability and protection he was looking for. And the reality is that he may or may not be successful with his AI startup. We know that. That could be something that goes and gets absolutely awesome, or we were all wrong because the assumptions we had was one, and 6 months later, AI is something so much more, and that it's just whatever, right? I mean, you got to be very good with the timing and the product and lucky and all those things, right? So that's what he did. And I think that's a great example of how we actually help build the economy, help someone live their dream and have actually create stability. Because think about it again. He took some money, put it with us, thinks of that sitting there and working passively in the background. We create jobs and housing with that money, so it goes to good. We're growing the American economy with it. And he's getting his return. He's just reinvesting it. So should he be wrong with his startup, he can still pay for his mortgage and take care of his family. And what happened is you can see, and I think you alluded to that early on, John, how it actually reduces a lot of the stress. He actually is now more all in with his venture, and he's not afraid to lose. And when you're not afraid to lose, you're playing to win. I believe his chances of winning are higher.
That's entirely true. I mean, no doubt about it. After I had my first exit, that completely changed my mindset on a lot of things, because there's certain things I don't have to worry about anymore. And that allows me to take risks that are much, much greater. Now, our situation is, with my wife, we're both professionals and we both do well. And so I've always had, even early on, I had some of that backup behind me. And so it allowed me to take some risks, but now I can really take risk in a much, much larger fashion. And sometimes that works out really great. Sometimes you completely crash, but sometimes it really is an amazing thing.
Hey, Dr. Pilot, don't talk about crashing and your risk tolerance for flying upside down and all that. It's awesome. But I think the moral of all that we were talking about here is that this is not something that it's only available for the rich anymore. This is available for high earners, great people in their career. You just need to start making some of these changes early on and start taking charge and truly be the owner and CEO of your own life. And that actually includes your own wallet and your family's future, your future. You can't outsource that to some whatever, right? No, you're in charge.
Fidelity.
Use service
Whatever.
providers to do work for you that you understand, instead of just succumb underneath them and said, no, my financial advisor said I should just put my money in this, mutual fund and this stock portfolio. Okay. How much money does he or she make out of that recommendation, regardless of what happens to the stock market? Oh, it's between 0.5 and 1 point per year. Okay, so you just want to pay an extra tax for someone to just say and go and buy something that you can just go buy yourself at Robinhood that goes like this over time, and you think that's low risk? You have absolutely zero control of what's going to happen to that. You have the whole economy, and then we have all these modern phenomena that we've seen the last maybe 5 years, where someone is tweeting something on, I guess it's called X now, but whether it's the world's richest man or the president or whatever, and they just say this or that, and you see the stock market up or down 5-10%. Do you think that's control? I find that to be gambling.
Yeah,
That's speculation.
It is gambling.
It's speculation.
I fired my financial advisors decades ago. I don't like that whole thing at all.
So I
would much rather.
Let me ask a question, Mark. Let me jump in here and ask a question, because we want to keep this show where people are going to actually listen to it. And since we're not talking about true crime, we're talking about life choices and liberty and freedom and the ability to be able to afford to make mistakes, right, Eric? I mean, that's a huge chunk of what's underlying all of this.
That's it. That's part of it.
Yeah, if someone wanted to learn more about what you're doing with Valhalla Capital Partners, I know they can go visit valhallacap.com, but if they wanted to chat with you and get in more detail, man, what's the best way for folks to find you?
Yeah, so I'm obviously not at liberty on a podcast and talk about the detailed intricacies and all that of the funds. It's just the world we're living in. We are only available for accredited investors, but please just go to valhallacap.com, and there are plenty of links and overview of what we stand for, what we do, and you can get in contact with us. We would love to have a one-on-one conversation with you and, see if there is a fit for what we do with what you're trying to do. So would love to do that.
Awesome. Yeah. Well, I want to say thank you, Eric, for joining Mark and I today, because I think you're addressing something that, if you're going to be an entrepreneur, if you're going to be a risk taker with your career and your profession and what you do, you need to plan ahead a little bit. And look, there's some things and issues in life that are unavoidable that'll just beat you up. And I could go on about that for a while, but at the end of the day, man, if you have a chance to secure the future for your family and have a platform from which you can launch your rocket ship, then man, that's pretty awesome. So thank you for sharing this with us today.
Yeah, thank you so much for having me, and it was a pleasure talking to you guys. Appreciate it very much.
Thank you.